All right, Adam, thanks very much. Well, Wall Street right now doesn't like what it heard from Ben Bernanke. At first, it went positive. Now it is negative. Not terribly so, but it's down about 12 points.
Is a pattern.
The question is, how about Main Street, though?
Yeah, the pattern is that every time he speaks, we've been seeing a little bit of a sell-off here. But let's get some instant analysis. What a day, guys. Our Fox panel includes Biz Radio Network host Mike Norman. Okay,
he's
that's
raring.
fine. We also have Tom Atkins of Remax Fairlawn. That's fine, too. But throw this one in between these two guys. We've never had them
together. We need a big shot.
Yeah.
We need a big shot. There you go. There's the team.
That's Peter Schiff on Crash Proof, and you're on Brooke. I don't know
if I should be in the middle here.
Brand Institute. Okay, so here we go. We heard Ben Bernanke. Tom Atkins, you take this one first. What he said still seemed to feel like he was turning on to the course of worrying about growth versus inflation. That means rate cuts in the future, does it not?
Yeah, and look, the Fed put themselves in this position. They crushed the housing market, and now they're coming back and saying, like, okay, now that we made that mistake, now that we're facing inflation, we're going to cut interest rates because we're worried about resurrecting the housing market at the expense of inflation. But the fact is, they got to do either one or the other. Peter's on the side of controlling the economy correctly, which makes a lot of sense. I'm on the side of getting the housing market back, which makes a lot of sense. The point is, the Fed the Fed put themselves in a position where they're damned if they do, they're damned if they don't. They got to take one or the other. They decided that it's better to fight inflation from the point of a strong, growing economy. That's the move they made, and they're sticking to it.
Peter Schiff, we hear tales of a 0.75% interest rate cut. That would equal the greatest cut that they ever had, at least in modern history, at the Federal Reserve Board. What would happen to our economy if that happened?
Well, it's just more inflation. I mean, look at what's happening to the dollar now. It's like monopoly money. Look at the euro today at an all-time record high. The Swiss franc, the Australian dollar, the New Zealand dollar. Look at silver up another 60 cents today. It's over $19 an ounce. Gold is closing out at $1,000. It's going to go a lot higher. They are debasing our money. It does not help the economy to create inflation.
So you're on the side of raising rates at this point?
Yes, even though we're going to have a recession. And, you know, Tom says the Fed killed the housing market, but they blew up the bubble in the first place. And there's no way to restore
the
Fed did.
Right.
We never would have had these sky-high home prices if it wasn't for the low interest rates and the lax lending standards that these low interest rates made possible. So we need to go back to sensible housing prices, but that means that millions of Americans owe more than their homes are worth, that the fantasy of instant wealth by owning a home is going to, collapse, and we're going to have to suffer for all this consumer borrowing and spending.
Look, Peter talks about inflation, but one place where you don't see inflation is precisely in the housing market, and that is the largest component of household net worth. What the Fed is trying to do here is avoid very simply a disaster in the economy where you have a couple of million homes going into foreclosure that ends up tanking the entire economy. Look, we did this market-based workout system in the past. It was called the 1930s. It didn't work. This is a textbook application of both monetary and fiscal policy. It is already having an effect. You see stability coming back not only in the stock market but also in the home builders. So you got to give it some time. And I think this idea you got to have this laissez-faire, just let the market work it out. Look, it worked it out on the upside, and it was a disaster.
Well, you're on. We had a drop of 8%. We got the news yesterday that housing prices have dropped 8% in the past couple of months. But consider that housing rose 70% in the last 3 years. So that an 8% cut isn't that bad when you put it in context.
No, and there's still a long way to go, I think. And to me, it's astounding that we got these horrific inflation numbers yesterday, and the market didn't even respond. It looks to me like there's a bubble in the bond market. The stock market doesn't respond. People don't care about inflation. Well, we're going to pay the cost of that. There are no free rides here. We're going to have to pay the cost of the bubble. We're going to have to pay the cost of this liquidity, of inflating this economy. And if we don't pay it now, we'll pay it longer term. But there's going to be a lot of pain out there. It's just a question of whom and when it happens.
Wall Street might not have cared about inflation, but I think people out there who are watching right now care about inflation.
Sure. I mean, that's what I said. That's why the dollar is selling off. That's why commodities and gold are rising. People want out of dollars because of inflation. But, Mike made the point that home prices are falling. Sure, they're going to keep falling, but that doesn't negate the inflation. Remember, when housing prices were rising and the government claimed there was no inflation, housing prices aren't part of consumer prices. prices, they're an asset. And asset prices can be falling while goods prices, consumer prices are rising. And that's what makes it so terrible. The value of what every American owns is sinking, but the cost of everything he has to buy is rising.
Not what every, stocks are not sinking. Look, the inflation problem, Bernanke said this today. The real underlying cause of the inflation problem is oil prices, because oil also ties into food. We have the biofuel whole theme going on. Corn 2 years ago was $2. Wait a second, was $2 a bushel. Now it's $5, $6 a bushel. When oil prices moderate, and there's an argument to be made here that if U.S. economic activity is slowing down, and it looks like it is, maybe globally we're seeing a slowdown too. Oil consumption in OECD nations slowing down. You're going to see oil prices come back down.
I got to say, though, today, for the first time in history, it takes $1.50 to buy €1.
51.
So
$1.50. It went above that $1.50 mark for the first time today. That means that the value of the dollar has. I remember when $1, when it took about 80 cents to buy $1.
You know who that affects? It affects people taking vacations in Paris.
Doesn't.
That's who that affects.
Importers, exporters.
We hardly import anything from the European Union.
We warned you it was going to be exciting, folks.
There's one I understand the Fed's,
last word here.
The Fed's gamble is very simple. They're gambling that the slowing economy is going to curb inflation. And the risk is that we may very well have stagflation from rising energy costs along with rising long-term interest rates. And that's going to be the Fed's gamble, whether they've ridden the horse into town on time.
Got a heartbreak coming up. Thank you, gang.
I just want the Pop-Tart prices to come down now. Okay, now.
The kids like Pop-Tarts?
We'll buy you some.
Oh, okay.
I do.
All right. Well, it could be that. Robert.
What an exciting day for commodities. I mean, first, oil and gold both hitting new highs, at least for oil intraday, where it went above $102. Don't worry, it's below that now. But is this where you should be parking your money while stocks still seem a bit uncertain?
Our Fox panel is back now to talk about it, and we include, for your eyes only, independent trader Eric Bowling, who is at the NYMEX, where these commodities are all traded. Okay, what a day it must have been down there, Eric. We saw it over 102. Right now it has come down below 100 for the first time in 24 hours or so. What does it all mean? Where's it going to end?
Well, I think this morning early we traded up to $102 a barrel, and that was very, very quiet trading electronically overnight. And that was on the heels of a little bit of nervousness, and also, guys, the dollar, again, it was down up to 1% again today. So you saw all the commodities ripping. You saw wheat at an all-time high. You saw gold at an all-time high. Silver, all these commodities, they all backed off with the exception of wheat. It still is higher, all-time high, but across the board, the grains backed off. I told you I shorted some oil yesterday. I shorted some more again today. We had some bearish inventory numbers that came out in the oil market today. So I think, if nothing else, you're going to see a bit of a profit-taking session across that commodity board right now.
Can I just point out, Eric, too, gasoline is down 7 cents to $2.47. That, of course, we know is the wholesale price, not what people are seeing at the pumps. But do you short gasoline as well? Because you've got people wondering, should I be buying gasoline?
You found the right one. The right one. That gasoline number right now is coming down on the wholesale level. Now, don't forget, it's up substantially over the last 30 days, and that has to trickle down to the pump. But we're literally 16 weeks in a row of building inventory in gasoline. That's a good sign for the oil market. It's a good sign for gasoline price going forward. I think you have a little bit more to go higher on the pump, and then maybe it backs off.
So there's a little bit of good news here.
Well,
there is some real good news.
Eric's right, short in the oil right here, because as he points out, 16 weeks in a row of building inventory in gasoline, 7 weeks in a row of building inventory in crude. Gasoline stocks now 10% higher this year compared to last year, but we know the economy is slowing down. I mentioned earlier OECD countries consuming less. Sooner or later, what's happening here is very simple. It's pure speculation. But sooner or later, the economic fundamentals will catch up with the market. Prices will come down.
Hold on a second, guys. I just want to let our viewers know something, that we're having a bit of a problem, you may have noticed, with the lower part of our screen and some of our averages. So what we need to do is have you go to foxbusiness.com, and all of that information will be there for you, and it'll be current and correct. So just so that you know. But in the meantime, you didn't say whether they're good investments here.
Commodities?
Yes.
Look, I think you're in a phase which I could only characterize as a speculative bubble. If you like doing that, if you believe in the greater fool theory, in other words, you buy and another fool's going to buy at a higher price, then go ahead and be my guest and do it.
All right. Well, I mean, I've been encouraging my clients to buy commodities almost as long as Mike's been discouraging people from doing it. And, you know, we've made a lot of money. When I first started buying these things 10 years ago, very few people were with me.
10 years was a good time to be buying them, and I was buying them back then.
I know you were, but you stopped buying them about 5 or 6 years ago.
I know you are, but what am I? Come on, get to it.
Look, the bottom line is, look, they're still going to keep going up. We're creating a lot of inflation. You know, Ben Bernanke, the same guy who said that the subprime market is contained, the subprime problems are contained, is now saying that inflation expectations are well anchored. They're not anchored. They're as anchored as they were contained. Inflation is getting worse. Prices are rising as a result of inflation. Our money is losing value, and as long as our money is losing value, commodity prices are going to continue to rise.
Well, Tom, they're the same thing. I mean, if you have the value of the dollar going down and you have inflation going up, it affects the people that are going out and buying things. If your dollar's worth less, you can't buy as much with it. It's as simple as that.
Yeah, but you still need to find out why and try. And according to all the experts, you would hope that the Federal Reserve and other such people.
Rate cuts are not helping.
No, they're
not.
Know that. But keep in mind what kind of inflation.
Because that leads to the dollar being debased.
It depends on what kind of inflation you've got. If you've got inflation due to an overheated economy, that's no, there isn't. Not even close. What college did you go to?
I didn't learn that in college.
Neither did I. Which makes perfect sense. If you have inflation due to an overheated economy, too much money chasing too few goods, you better raise interest rates. If you have inflation due to strictly to commodity prices rising, the Federal Reserve may actually consider going in the opposite direction. And that's exactly what's happening right now.
That is the first time. Hold on. That's the first time I've heard on this program that spelled out that there are two different ways of looking at it. Do you believe that? And in that case,
no.
What do you do about the rates? No, you don't believe that?
No, I don't believe it. There's only one cause of inflation, and that's printing money and creating money. When you create money at a fast rate, you cause inflation. It's sometimes expressed in home prices, sometimes it's expressed in commodities prices, sometimes it's expressed in consumer prices. But when you print money, that is inflation. And when you print money faster than productivity, that causes bubbles and inflations.
Oil is
going up because of inflation, not the other way around.
We do not have an overheating economy, yet we have inflation.
No, we don't. No. Here's why. Because
we're printing money like crazy.
We're
lowering interest rates. We're creating money like crazy in this economy, and that creates inflation.
Okay, hold on.
You can have all kinds of different kinds of inflation. You know what? Go to any decent economic school.
There's only one inflation, guys.
No. If you have inflation due to strictly, let's just say tomorrow that all the oil-producing nations just like fell into the ocean, and now you have as much oil on the market right now. It's not because you're printing money that the oil prices went up.
Other prices would fall.
No. The reason why you have
prices would come down, and overall inflation would be
forget about the bottom of it. Read my book.
Bottom line. Hold on a second. Let's get back to some bottom line realities. Eric, you're shorting oil. You're shorting it for how long? How long do you think it's going to be going down before it ticks up again?
Till next minute.
Let's not forget one thing. We're talking about printing money. Yes, we are printing money, but we have to right now. We need economic growth to start again in the U.S. Well, let me finish. Outside the U.S., things are growing. That's going to keep things in balance. I am shorting oil because it's overbought right now. I'm shorting wheat because it's overbought. Long term, we're going substantially higher in both gold, wheat, commodities, and metals across the board. This is just a money flow out. It will flow back in. I look to buy these things back later, not substantially lower, maybe 5-10% lower from here.
Still tough for the average investor, though, David, to get in on this.
Commodities is a very tough thing to be trading at any time, but particularly now.
Especially in stagflation, which is what we have right now.
All right.
No.
That'll be for the next argument. Okay, we got to move on.
Microsoft computing the damage after the European Union hits the software company with yet another massive fine.
$1.35 billion. It is the biggest ever penalty handed out by the EU. They say Microsoft failed to comply with an antitrust ruling. So is the EU out of control? Let's ask our next guest, Fox News legal analyst Judge Andrew Napolitano. And Judge, let me just put a fine point on that fine. The maximum potential fine that they could have received was 1.5 billion euros, which would actually be a lot more. They received 899 million euros, which calculates to 1.35 billion million. But I'm not exactly sure what they received the fine for. Can you explain?
Yeah, the numbers are staggering, David and Liz. Basically, the EU Commission that regulates commercial transactions in Europe said to Microsoft, let's see, you settled this case in the U.S. because you wouldn't let competitors' software work on your hardware. What we want you to do is to give us the documents, give us the technical information so that we can tell competitors in Europe how to make software so that it will get on your hardware. And Microsoft said, no way, we're not going to give you that. And the EU said, okay, we're going to fine you 2 million euros a day until you give that to us. And finally, Microsoft said, uncle. And when the 2 million euros a day got to 1.35 billion, Microsoft said, here's your check. And anybody that wants the technical specs will license it to them for a mere 10,000 euros, a flat rate, so they can make their software work on our hardware.
Was that enough to satisfy the EU, though, Judge?
Yes, it was enough to satisfy the EU, although perhaps because Microsoft let this go on, Liz, it's a great question, for as long as it did, it provoked the EU to open up 2 more investigations of Microsoft. Now, we don't even know what they're looking at in those, but they announced when they received the 1.35 billion, by the way, we're about to start 2 more investigations of you. So Microsoft's utter defiance of the EU has resulted in putting it in the dock. Again, we'll have to see what that case is and where it ends up.
Now, Judge, under EU law, dominant companies, and I'm using their phrase, dominant companies like Microsoft have an obligation not to impede competition. Not talking monopolies here, something called dominant companies.
It sounds like it was written by a socialist, doesn't it?
What do they mean by dominant companies? I mean, isn't it fair to compete with a competitor?
In European speak, which basically stems from not the free market system we have here, but a cradle-to-grave, the government will take care of you system. If you become too big and too strong, not a monopoly, but dominant, meaning something close to 50% of the market, which you've acquired on your own, through your hard work, through selling a product that the public wants, you then have to make it easier for competition to take you on. Fortunately, we have a constitution in this country which would prevent such a law from existing here.
Judge, we're going to bring in the panel, and I remind all of our viewers, Microsoft once wasn't dominant. It started in a garage with the Bill Gates dropping out of Harvard, and Peter Schiff and Mike Norman. You know, Mike, you can take this first. I'll let you go here. This is almost, it seems to me, like telling the fastest Olympic sprinter, hold on, slow down so the other guys can catch up.
Well,
that's outrageous.
It's outrageous to us, but listen to what the judge says. I think he's absolutely right. And by the way, what was Microsoft thinking? They're not. It's not playing, within the rules of the United States with its fair and competition. It is, as he said, the judge, this cradle-to-grave society where everybody is taken care of. And if you start to get the slightest advantage over somebody else, a competitor, you've got to relinquish that advantage. So I mean, and then by digging in their heels and having to, incur such a huge fine, and then in the end, they have to give the secrets away anyway, right? And pay the fine, and it's a big fine even for a company like Microsoft.
So non-compete with your competitors. That's the rule that we have to play by.
Sure. Look, this was a government shakedown of Microsoft. I mean, they're a bunch of thugs. That's what governments do. But all this antitrust law in our own country too, it does far more harm than good for competition. You go back to the first antitrust case with Alcoa Aluminum, and you read what the judges did. They busted up Alcoa and fined them not because they were a monopoly, but because they were providing a service that was so good that the products were so inexpensive and so preferable that nobody else could compete, and therefore they were doing something wrong.
Surely, Tom, you side with the European Union.
Here's what I got. You got a bunch of cheese-eating socialists versus a megalomaniacal Microsoft.
Is that a yes or no?
May they die in a fiery death embrace, okay? No. You've got the European. They can't get socialism out of their skin. They've been trying to go capitalists. They've been trying to cut their tax, but it's like.
Okay, I think we've had enough adjectives. You're on, Brooke. Have we finally found an issue on which everybody can agree?
Maybe. I'm not sure Mike agrees yet. But let's return to what Peter said. I think it's important here to know we can bash the Europeans all we want, but this all started in the U.S. The U.S. is the one that filed antitrust against Microsoft 10 years ago. Microsoft used to not lobby at all in Washington. $0 in lobbying. Yeah. Today they spend hundreds of millions of dollars lobbying in Washington. It's American antitrust that started all this. It's Washington that's ultimately at fault. All these governments, it's all shakedown, and it hurts the markets.
Judge, what's the best way that Microsoft should deal with this now? Because their last attempt of not paying and digging their heels in ended up with them paying a lot and getting a subsequent investigation.
They have to recognize, Liz, that the EU has real power. It has the power to take a lot of wealth away from them, and it has the power to stop them from doing business in Europe, and they have to play ball with that. Look, if they started licensing this stuff, I think it's socialism, but if you want to do business in Europe, that's what you're faced with. If they could have started licensing this information 10 years ago, they would have saved themselves $1.5 billion.
Is it worth it, Peter? Is it worth it to deal with all these rules that we all agree are uncompetitive?
It's not worth it at all. We should just let the marketplace work. You know,
but is it worth the interests and the finances of Microsoft to go in there, pay the fine, say, look, we can make a lot more money than we have to pay off in fines?
Obviously, Microsoft makes a decision there, and they probably made a decision that it was worth it. But I mean, as far as for society, it's certainly not worth it for society to empower government to bust up companies.
You're wrong. America is the greatest wealth-producing nation this earth has ever seen, and we operate not under raw capitalism, but American-style capitalism, which we use, busting up monopolies. Trust, look, capitalism exists very well with the existence of monopolies, existence of monopolies. Okay. We bust that up, and I think the proof is in the pudding here.
You're on 10 seconds. Go.
I'd love to see Microsoft, they won't do it, but I'd love to see Microsoft withdraw from Europe, let the Europeans taste what it's like without Microsoft's product, without this brilliant company.
Well, guess how soon they steal the product,
It won't happen,
by the way,
but it would be great to watch.
You would find more copying of material than you find now in China if they were to do that. And I think they've calculated the risk.
They can't even copy that well.
Probably.
Well, maybe you're right.
But note that that's the threat against them.
Okay, gang.
It's good to see everyone's impassioned by that. The closing bell is just over an hour away. We're down more than 20 points on the Dow.
But the NASDAQ is up, so there is some positive news to report. Be sure to email your questions, Liz and Dave at foxbiz.com.
Fed Chairman Ben Bernanke saying there's plenty of down risk left for the economy.
Well, does that mean we haven't hit the bottom yet? And does it mean that another rate cut is coming? Let's ask our Fox panel about it. Going first to Euron Brooke. Euron, you got the sense, didn't you, that in fact the Fed wasn't finished cutting rates, and there is even talk, we should mention it's a small percent, but talk that there might be a 0.75% cut in the Fed funds rate. What would that do to our economy?
Well, I wouldn't be surprised. I mean, they're concerned primarily in bailing out the banks and bailing out the financial institutions. If they really want to get credit flowing in this economy, what they need is massive deregulation of the financial markets, not the increased regulation that they're proposing. What that's going to do to the economy when you lower interest rates like they are right now into an environment where PPI yesterday was at the highest rate in 26 years, it's more inflation or more inflationary, more misallocations of capital, more distortions into this economy. You're not going to get the kind of economic growth, the healthy economic growth that we'd all like to see.
Let me read a viewer email that just came in about this inflation issue. This is from Lucy in Washington State. She said, inflation is a big concern out here in flyover country, and a large garden and a wood-burning stove are about all we have as far as answers are concerned to this problem. So, Peter, people are really feeling it. But I'm also interested in the aspect about the credit cards where he's now suddenly deciding that he's seen God here and as real, oh boy, credit card companies might be too tough on people at this point where people are suffering anyway.
Well, the credit card companies are going to get a lot tougher. And if the government tries to stop that, see what's happening now is credit cards are looking at all their exposure to all this debt. A lot of people have credit cards and they now have negative equity in their homes, and credit card companies are worrying about people charging up money that they can't afford to repay. So they're starting to cut back on people's limits, reduce their credit lines. And now the government is thinking, hey, this isn't fair, you know, you're changing the rules of the game midstream. But credit card companies have always reserved the right not only to lower the limit, but to say, hey, you have to pay up in full right now.
Yeah,
and if we cut down on
sneaky,
they
though.
also
They've
charge
raised
20,
interest rates.
30% interest rates, which is a usury rate.
Just talked to somebody today who said that her husband missed one payment and immediately it jumped up to 31% as far as the interest.
Yeah, that's how you get in trouble, because you could never pay that rate. That's what a loan shark charges.
Sure,
I mean, for crying out loud.
But Tom, is it possible that what Bernanke is trying to do is to head off the regulators at the pass? That is, you hear a lot of talk inside of Congress of even more draconian sort of measures to cut back on what credit card companies and mortgage lenders, frankly, can do. And Ben Bernanke, by putting this out there, is saying, look, I've got my eye on it. I'm doing something about it. Congress doesn't have to leap into the fray.
Yeah, and the Federal Reserve has control over more than just interest rates. They can do a lot of things. However, the thing that drives me crazy, and I was watching some of the testimony today, and I think everybody here will come to agree with this, the thing that really scares me the most watching Ben Bernanke speak to Congress is not Ben Bernanke. It's Congress. It's amazing how stupid these people are. And look, I don't say this like gratuitously. They're really not that smart about economics. They don't know what they're doing. The best thing the federal government could do, stop spending money on stupid things that don't work, lower taxes, get rid of the AMT. These are easy things. You want to spur the economy on. You know, sometimes I think the Federal Reserve is trying to overcompensate for the mistakes of the federal government, and you're putting the Federal Reserve in a can't-win position. Look, Bernanke, I think he's doing the best he can. But I really think a lot of this goes back to the federal policy, how much money we're spending, where we're spending it, how we're spending it, and how we're taxing it.
Yoron, at one point, he did have to say to one of the Congress people who asked a question, I can't actually get us back to the silver standard or the gold standard. You know, that's not my job. That's actually your job.
That's actually, yeah, that's right. I mean, I wish Congress would take him up on that and get us back to the gold standard.
That's crazy.
That would save us a lot of these problems and get us back to a proper gold standard of private banking and economic growth. You talk about overheating the economy. Economic growth can be at 9–10% with no inflation, and that's what you get on a gold standard. So 19th century was a wonderful time of economic growth. You know, the mythology that you portrayed.
It was wonderful.
We've changed a little bit, though, haven't we, since then?
We had a gold standard.
Hold on.
We had a gold standard when we had the 1929 stock market crash, and it constrained the Fed. The Fed was not able to cut interest rates because if it had cut interest rates, there would be a run on all the gold in this country. Foreigners would come take their gold out, and that was precisely what caused the depression. If we went back on the gold standard,
Peter?
like Yoron says, we'd have the depression.
Look, what happened was we got the Federal Reserve in 1913. The Fed kept interest rates much too low during the 1920s to help out Great Britain.
Rookie mistake.
They basically ignited the stock market bubble that burst. Had we stayed on an honest gold standard without the Federal Reserve, we never would have had the bubble of the 1920s, and we never would have had a depression.
No,
the depression was created by Hoover and Roosevelt and their government.
Hold on a second. Hold on a second. Go ahead, Tom.
Now you're onto something. Federal policies screw things up. Whether you have a gold standard or a Federal Reserve, the government can make it impossible for either one of them to function. If the government makes massive mistakes like taxing too much, spending too much,
but Tom, if the government can't print money, which is what the Federal Reserve has the authority to do, and the Congress, you know, if they are stuck to keeping the currency based on the amount of gold that we have in reserves, they can't spend as much as they are now.
Yeah, but the problem is that we're creating much more wealth than we have gold represented. That's why you need a Federal Reserve instead of a gold standard.
That's a good point.
Exactly. Yes, it is. Oh, yes, it is. Yes, it's not. That's exactly the reason why. What do you mean ridiculous? It's exactly the reason why.
All right. Can I just bring up Fannie Mae and Freddie Mac? Okay. Federal regulators giving Fannie Mae and Freddie Mac a bit of a boost today. Both of these embattled stocks are up after the government indicated it would lift the limit on how many mortgages these companies can buy up.
Now, the restrictions were put into place because of past accounting problems, but now some are hoping Fannie and Freddie can help bail financial firms out of the mortgage mess. However, could they actually end up fueling the fire if banks start easing their lending standards once again? Our Fox panel is back now to discuss it. Fannie and Freddie, Peter Schiff, what's going to happen to them?
Well, all this does, if it means they can buy more mortgages, then certainly lending standards might ease a bit for those mortgages that they can unload on Freddie and Fannie. But all it does is create a bigger problem for these companies, because it only means they insure more mortgages that are likely to go bad.
Will they survive?
I don't think so. I think Freddie and Fannie are going to go to zero. I think there's no hope for the shareholders.
Zero?
Well, I think they're going to go bankrupt. I think the big question is what happens to all the bonds they insure. Will the government step up and bail and guarantee?
They have a duty to do that.
Well, we don't know. It's untested. It's not a full faith and credit guarantee. It's an we assume that they're going to, and I don't know, because obviously where's the government going to get the money to bail out all these failed mortgages? All they can do is create it. All they can do is print it, which means there's a lot more inflation.
That's not what's going to happen. Look, Fannie and Freddie been around for 70 years. They were doing fine. You can track the peak of the housing market to 2005 when the crackdown came on Fannie Mae in terms of tighter regulation, in terms of the government telling them they have to reduce the size of their portfolio. It took an enormous, Alan Greenspan once said that simply because Fannie Mae and Freddie Mac were perceived as being backed by the government, that injected an extra $140 billion annually into the mortgage market. It was a huge amount. And when the crackdowns came, you saw the withdrawal of that liquidity, and it started to cause the housing market to go into a downturn. Getting this relaxation in their limits now, I think, is a very positive thing, and it's going to be a benefit and a boost to at least to add some stability to the market.
Yoron, my only problem with it, and I'm with Mike because I've followed these stocks for several years now, close to a decade, and they're not going to zero. But my only problem is they can't even keep their own financial houses in order, yet you're going to give them this brand new latitude in writing brand new mortgages when they can't seem to get it together with what they have.
Absolutely. These are two really government agencies that are as corrupt, I think, as most government agencies. They can't do their accounting, just like the federal government can't do their accounting. But look, these guys fueled the crisis. Mike is absolutely right. They kept pumping money into the mortgage market. This is what caused the subprime mess. Giving them more capacity is just going to create more problems. The best thing we could do is not drive the price down to zero, but unwind their positions. Get rid of Freddie Mae and Fannie Mac. Let the market create entities, not backed by the government, but create entities that do the same thing if it's appropriate for the market to do so.
Let's talk to somebody who's really got skin in this game, a guy who's really into real estate, Tom Atkins.
First of all, the subprime mess wasn't caused because there is actually more money in the market. It's primarily because we had this great balance for almost 20 years of subprime, where you had loans that were not conforming, not Fannie Mae and Freddie Mac. They were loans that were outside, maybe less money down, maybe they're higher than most house prices were, and when Alan Greenspan and Ben Bernanke conspired to raise rates 525% in 3 years, that's what crushed the subprime. That was not a conspiracy, just a screw up. So that's the first thing. Look, there's the difference between conspiring to do something stupid or just being stupid in the first place, just by accident.
Right. We did the Fed. Let's do Fannie and Freddie.
But Fannie and Freddie primarily are very safe mortgages. They'll be the last thing to collapse if there ever is a collapse. And if there is, it's going to be minor. It's not that big of a deal. The subprime are going to be eating up. They're the biggest risk loans. They're the ones that are taking the biggest pounding. The ones that are prime mortgages, ones with 20% down and more, the ones where people were very safe bets, completely conforming, completely, everything they signed was documented. These are the easiest, most safest loans out there.
What should the Fed have done with interest rates?
Then we don't need Freddie Mae and Fannie Mac.
No. The Fed should have done. They should have come down quickly, moved up slowly, and not come down as far as 1%. They should probably come down 2.5, maybe 2, and then going back up as inflation was. Yeah.
The Fed could also leave interest rates at a level and allow the imbalances, if you want to call it that, to be adjusted in the foreign exchange level of the dollar. The Fed tries to target inflation, it tries to target interest rates. They're both, it's sort of a moving target.
The mistake they make.
And it's difficult to do. And we always look back, with 20/20 perfect hindsight and say, well, you should have not gone down this low, or you should have not raised them. But, they react to conditions, and it's, by definition, a sort of, a rearward looking.
Freddie and Fannie, you can't argue with Euron's point, Tom Atkins, that they've been terribly managed in the past. They're sort of a political there are political gifts that are given out, positions in that organization. People make millions of dollars as a result of their friendship with people in government.
They don't promote people who are competent. They promote people who are
well-connected.
Butts, yeah.
And what do we need them for?
Well, no. It's important to have Fannie Mae and Freddie Mac. Without it, you can't expand and put enough money. No, you can't put enough money out there for people just to buy houses. It wouldn't exist. Rates would be 25 or 30%. That we wouldn't be able to do it.
They're trying to sustain these artificially high home prices with all this extra credit. If we didn't have all these entities, even if we took away the tax breaks for real estate, it wouldn't make it more difficult for people to buy homes. Home prices would just come down.
Last and first word, by the way, with Peter Schiff this time. All right, the countdown of the closing bell. It's not a conspiracy. Is on, folks. The Dow Jones Industrial Average is still up 11 points.
Stay tuned. We've got much more on Fox Business. We're coming right back.
Going over and
The market's teetering between red and green arrows at the moment, but for the moment we have the red beating out here, down 5.5.
Down 5.5. It's as close to flatline as you can get. Earlier, the Dow moved higher on hints from Ben Bernanke of another rate cut. But then what happened? Let's take it to our Fox panel and talk to the son of a fireman, Mike Norman.
All right.
What do you think?
It's on fire. No, we had 2 days of very big upward move. We got back up to the level we saw, I think, last month at high level. So you got to figure we're going to get a little bit of a pullback. Look, I go back to what I've been saying. I think we're starting to see signs of stability, not just in the market. I mean, you also see it in certain sectors of the market. You see it in the home building stocks. You see people like Wilbur Ross, Warren Buffett starting to make bids on, the bond insurers, this so-called repricing. It's happening, and we're starting to see, prices emerge, or at least where people think they're willing to take a shot. I think that's a positive.
Is that the message for the average person to start picking up good names?
Absolutely. I think you can do that, and I think, you have to be patient still, Liz. You don't want to look at it like, what am I going to make in the next month? But keep a time horizon of the next, year, 2 years out. I think you'll be fine.
Yeah, no, I think the average person still has to look at the Dow, realize the dollar got crushed yet again today. The Dow is priced in dollars, and if the dollar loses value, the Dow loses value. You cannot separate the two. They're one and the same, and people have to understand what's going on, and if they really want to preserve their wealth, they got to sell these Dow stocks, they got to sell their U.S. assets, and move their money abroad. They got to buy foreign stocks where the currencies are not being debased as much as ours.
Which are your favorite countries right now?
Well, I really like the Asian countries. I do a lot in Hong Kong and Singapore, but we've got a lot of money in Australia, in New Zealand, up in Scandinavia, up in Canada. We own a lot of commodities, too. We're still buying gold and oil and silver.
But I got to say something, Tom. Even if you take everything that Peter says about the dollar and gold and everything for face value, and frankly, a lot of it is good stuff. I agree with a lot of it. But what you look at American companies, and there are some fine companies, some wonderful entrepreneurs who are still creating new businesses in this country based on dollars, who eventually are going to go public, sell stock. There will still be some stock bargains in the market.
This is still the place to be. America has, so far, the best combination of personal freedoms, financial freedoms that exist in the world. So even though you may be tempted to buy France or buy, China or whatever, this is still the place people want to be.
But people are losing money in our stocks.
The people losing money. Hold it, guys. People understand that most situations that come up that aren't perfect are temporary. We fix them. They get taken care of, which, by the way, in other countries, it's not quite that way. In a lot of other countries you run into, their problems are inherent. Going to Germany, where the unions run everything, to the point where they can't create a good car anymore. Go to France, where an employer still has to spend an equal amount of tax to the government as he pays you in a salary.
Look at our stock.
It's still a place to be.
Look at our stock market from the perspective of someone in Germany who put €1 million into our market 8 years ago, and now it's worth 20%
if you're not
less.
a German, if you're an American, what difference does it make? Unless you're taking trips over to Dusseldorf or Frankfurt.
Hold on a second. We got another player here. You're on. We started out this session about 2 hours ago talking about this fine against Microsoft by this European regulator who essentially says because they are a good competitor, they are doing something illegal. In other words, competing in Europe is illegal. Is that the place you want to invest?
I don't. I mean, I'm not optimistic about Europe. The one thing Europe has going for it that we don't is stable monetary policy. They've been much smarter about their money supply. They haven't printed as many euros as we have printed dollars. Inflation outlook in Europe is much better than it is in the United States, and in that sense, it's a better place to invest.
Yeah, they also have 11% unemployment, which would be wonderful.
But can I just want to
I don't want to live in Germany. I live here.
Stable monetary policy.
Okay, guys, hold on one second. Tom? You just said they can't even make a good car in Germany anymore. That's a little bit outrageous. I mean,
let's see.
Would say
Mercedes. I have a friend of mine.
They had problems at Mercedes. They fixed them.
No, they didn't. They still make dreck. The average Mercedes right now has a repair record of the old Yugos. They're pieces of junk. A friend of mine owns a 2-year-old Benz. He said he wants to buy 2 of them, one for the road and one for the shop. They're crap. They don't make the cars anymore.
By the way, your check from GM and Ford just.
Peter has a BMW. Peter.
I've never had a problem with it, you know.
But the point is, Peter, again, you look at what's happening in Europe, you look at the regulators there, you look at their socialist mindset, and you can't think that's a better place to invest than here.
Unfortunately, despite all that socialism, despite all that big government, at least they're living within their means, as diminished as those means are.
Very diminished.
But they have a current account surplus, a trade surplus, sounder money. Our clients are making much more money, but we're making much more money on our European investments than anyone is making on U.S. investments.
Why do they all come here?
They don't know.
Why do they do that?
They don't all come here.
We get to silence all of you as the opening bell is about to ring in just 28.76 seconds here.